When we invest in company shares, we are essentially investing in its future growth and success. Therefore, understanding the company's financials becomes crucially important. Fundamental analysis provides us with information about a company's financial health and management efficiency. Now, in this video, I will dive into the concept of fundamental analysis and explore 5 important metrics that will help you analyze companies' fundamentals. By the end of this video, you will have a clear understanding of these metrics and how they can aid in making informed financial decisions. First is earnings per share, which is EPS. EPS is a metric that tells us how much profit a company generates per share. It is calculated by dividing the company's total profit by its total number of shares. Now, EPS helps us understand how well a company is performing, and generally a higher EPS indicates a relatively stronger company. Second is price to earnings ratio, which is PE ratio. PE ratio is a metric obtained by dividing a company's share price by its EPS. The PE ratio helps us understand how the market values the company. A higher PE ratio usually suggests better future growth prospects. However, it is important not to blindly invest in high PE companies. Their fundamentals should also be strong. Third is return on equity, which is ROE. Now, ROE measures the return a company generates for its shareholders. It is calculated by dividing the company's net income by its total shareholder equity. A higher ROE indicates that the company is generating a good return for its investors. It is also an indication of an efficient management. Next, dividend yield ratio, which indicates how much dividend a company pays to its shareholders relative to its share price. A higher dividend yield ratio suggests that the company provides a good return to its shareholders and allocates profits to them rather than reinvesting all the earnings. This metric is particularly important for long-term investors. And finally, debt to equity ratio, which is D ratio. D ratio compares a company's debt to its shareholders' equity. It indicates how much debt the company is using for funding compared to its own capital. Now, generally, a lower D ratio suggests that the company is financially strong and carries less risk. However, it is important to note that having some level of debt is also considered as a healthy part of financial management. Now, these metrics can assist you in making investment choices precisely. However, remember not to rely solely on these metrics. Conducting thorough research and analyzing the company's management, industry, and growth prospects are equally essentially important before making any investment choices. Hope this video was useful. Make sure to hit the like and subscribe button. That's it from me. I'll see you in the next.